The July 8th tape was not a clean panic. The Nasdaq finished green, oil jumped, housing rolled over, long-term yields stayed high. And Apple announced a massive U.S. chip supply deal with Broadcom. Those sound like separate stories. I think they point to one bigger question: who controls the physical machine behind AI? And by machine, I mean the very unglamorous stuff: energy routes, chip supply, domestic manufacturing, long-term borrowing costs. That is the kind of frame I want for this series, not here are 5 headlines, see you tomorrow. More like each market close gives us one clue, and over time, those clues start to show where the economy is actually bending. That is the market separating companies that can absorb a rougher physical world from companies that still need calm oil, lower mortgage rates, and cheaper money. I do not think this was just an oil story. I do not think it was just a Federal Reserve story either. And I do not think Apple's new Broadcom announcement was just a random tech press release dropped into the middle of a weird geopolitical day. I think those belong together. The thread is that AI is becoming more physical, more political, and more expensive to secure. For this episode, I am watching 3 kinds of control: control of energy routes, control of chip supply, and control of capital. That last one means balance sheet strength. Basically, who has the cash, margins, and borrowing power to keep building when the macro backdrop gets rough. If you control those 3 things, the messy macro world is survivable. If you do not, the AI dream gets more expensive very quickly. That matters because this is where the winners and losers can split apart very quickly. A company with a lot of cash, strong margins, and domestic suppliers can keep building through a messy macro backdrop. A company that needs cheap money, cheap fuel, and perfectly smooth supply chains has a much harder time. So the core thesis for this chapter is pretty simple. AI is still a big story. But the next winners may be the ones who control the machine, not just the ones who sell the dream. Let's start with the market tape because it gives away the whole pattern if you look at it the right way. The Dow fell 1.1%. The S&P 500 fell 0.3%. The Russell 2000 fell 0.9%. But the Nasdaq erased an early drop and actually finished up 0.2%. So this was not a crash headline. It was a sorting headline. That split matters. If everything were simply breaking at once, you would expect a cleaner everything red session. Instead, the market was making distinctions. The Associated Press noted that housing stocks helped lead the downside after rising Treasury yields stirred mortgage rate worries. Builders First Source fell 5.4%, Pult Group fell 5.4%, D.R. Horton fell 4.6%. Airlines and cruise lines were weak too. American Airlines fell 4%, Carnival fell 3.9%. That is not random. Those are exactly the kinds of businesses that feel pressure first when fuel gets more expensive and long-term borrowing costs stay high. Housing is the easiest example to understand. When long-term Treasury yields rise, mortgage rates usually feel it. That means monthly payments stay painful, affordability stays rough, and the parts of the economy tied to home turnover do not get much relief. The same logic hits travel in a different way. Higher oil means higher fuel costs, and airlines do not get to ignore that. They either eat the margin hit or try to pass it through to customers. Neither option is especially relaxing. But then you look at the Nasdaq and you realize the market was not giving up on big technology or AI outright. That is the key nuance, and it is the punchline of the tape. The market is not saying technology is over. It is saying fragile exposure is not getting a free pass. This was not anti-tech. It was anti-rate sensitive. It was anti-fuel sensitive. And it was anti-business models that need cheap money. The exposure is the important word there. Fuel bills, mortgages, refinancing, and demand that gets weaker when monthly payments stay high. The market was still willing to pay for AI leaders, but it was punishing the parts of the economy that need cheap money and calm energy to make the math work. This is one of those moments where the phrase market rotation can sound more complicated than it is. Rotation just means money is making choices. It is moving away from one kind of exposure and toward another. And on July 8th, the choice looked something like this: less love for rate-sensitive, fuel-sensitive, financing-sensitive parts of the economy. More tolerance for giant firms with cash flow and strategic importance. That is already a bigger picture clue. Because once you frame the day that way, the next questions become obvious. Why did oil matter so much? Why did the Federal Reserve minutes matter so much? And why did Apple use the same tape to tell the market it wants a lot more US-made chips from Broadcom? That is where the story stops being a normal market recap and starts becoming a map of where pressure is building. And this is where it connects to the prior chapter in the series. The July 7th episode was about the market starting to price the physical cost behind AI. The July 8th chapter is about control. Who controls the roots, the chips, and the balance sheet? If this kind of simple market map is useful, subscribe. The goal here is to build the bigger picture one episode at a time, so each daily tape becomes a chapter instead of just another pile of headlines. The cleanest pressure point on July 8th was the Strait of Hormuz. That sounds far away and abstract until markets remind everyone that it is not. As of this script window, the U.S. military had launched new strikes after it said Iran struck 3 ships in the Strait of Hormuz. The U.S. also revoked a license tied to Iranian oil sales. That is the hard event. Then the market did the math. Brent crude rose 5.2% to $78.02 and briefly topped $80. Why? Because the Strait of Hormuz is not a symbolic route. It is one of the key pipes of the global economy. The EIA says flows through Hormuz in 2024, and the first quarter of 2025 made up more than 1/4 of total global seaborne oil trade and about 1/5 of global oil and petroleum product consumption. It also carried around 1/5 of global LNG trade. That is why this matters. If you disrupt a route like that, you are not just moving military pieces around. You are threatening the movement of fuel, freight, industrial inputs, and power costs across multiple regions at once. And this is where the AI story quietly reconnects to the old economy. We like to talk about AI as if it lives in the cloud, which is a lovely piece of branding because cloud sounds soft and magical. It is really data centers, fiber, chips, cooling systems, backup generators, electric utilities, shipping lanes, and a very large electricity bill wearing a nice blazer. So if oil and energy routes get shakier, that is not just a problem for drivers at the pump. It is a problem for the cost structure of the whole system. That includes transportation, that includes utilities, that includes manufacturers, that includes data center economics. And yes, sometimes the market overreacts to this stuff in the short run. But even if the move cools down later, the signal still matters. The signal is that the market has to keep asking a new question. Can the next wave of growth handle a world where strategic choke points keep reappearing? That question is bigger than one day of oil prices. It is about whether the physical world keeps interrupting the clean digital story. And on July 8th, the answer looked a lot like yes. The next layer is the Federal Reserve. This is the part people often flatten into one sentence like, higher rates are bad for stocks. That is true in the same way saying gravity makes things fall is true. It is not wrong, but it skips the useful part. The useful part is understanding why the bond market and the Federal Reserve suddenly care more when oil risk, AI demand, and tariffs start showing up in the same conversation. The Federal Reserve's June 16th, 17 minutes were released on July 8th, and they were more revealing than the market probably wanted. The Federal Reserve minutes did not use my exact framing, obviously, but they pointed to the same pressure cluster. Participants discussed scenarios where inflation would remain elevated because of strong AI-related demand, the conflict in the Middle East, or the effects of tariffs. That cluster matters. Strong AI demand. Middle East conflict, tariffs, those are not 3 separate movie genres. That is one inflation and supply chain script. And the Federal Reserve basically said if those forces keep inflation sticky, some further policy firming could be warranted. Put simply, that means the market does not get to assume easy rate relief just because growth sectors would really enjoy it. The Treasury market reflected that discomfort. The official Treasury closes for July 8th put the 10-year yield at 4.56% and the 30-year at 5.06%. Those are not recession panic yields. Those are money is still expensive yields. For beginners, the 10-year Treasury yield matters because it acts like a base rate for all kinds of borrowing and valuation math across the economy. When it stays high, borrowing does not get comfortably cheap. Mortgage rates do not get much relief. Future profits get discounted harder. Leverage becomes less fun. Think of it like the background hurdle rate for the economy. If that hurdle is low, a lot of projects can clear it. A home purchase can make more sense. A business expansion can pencil out. A fast-growing company can tell investors, the profits are coming later, and the market may be patient. But when the hurdle stays high, patience gets expensive. The same future profit is worth a little less. The same mortgage payment buys a little less house. The same debt load feels a little heavier. That is why long rates can quietly change the mood, even when the stock market headline does not look dramatic. The 30-year matters because it tells you what the long end of the market thinks about inflation, debt growth, and risk over a much longer horizon. And when the 30-year is sitting above 5%, it is the market's way of saying, I still need a lot of compensation to lend long. That is where this becomes a control story again. If long-term money stays expensive, the companies that win are the ones that do not need much mercy from capital markets. The same is true for households. Housing becomes the pressure valve because a lot of normal people do not feel the Federal Reserve through a nice academic chart. They feel it through a monthly payment they cannot quite justify. That is why the home builder stocks got hit. The market was not just grumbling about a rate chart. It was saying the real economy still is not getting clean relief. So now put the pieces together. Oil is back in the inflation conversation. The Federal Reserve minutes pointed to the same pressure cluster: AI demand, Middle East conflict, and tariffs. Long end yields stay high, housing rolls over. That is not a side note to the AI story. That is the financing condition of the AI story. Now we get to the corporate signal that made this more than a macro scare. Apple announced on July 8th a new multi-year commitment with Broadcom expected to exceed $30 billion. The company said it would lead to more than 15 billion US-made chips and help Broadcom expand and modernize its Fort Collins, Colorado facility with a $1.5 billion capital expenditure investment. Important caveat, these are not Nvidia-style AI accelerator chips. Apple says the Fort Collins work is focused on radio frequency components, including FBR filters and advanced wireless connectivity technologies. That may sound like a technical side alley, but it is actually the point. The control story is bigger than GPUs. It is about domestic supply for critical pieces of the technology stack. That is not just a procurement update. That is a strategic tell. Apple is one of the biggest, most sophisticated operators on earth when it comes to supply chains. It does not make announcements like this because it wants applause for geography trivia. It makes them because secure component access, political alignment, and domestic manufacturing resilience are becoming more valuable. This is the new area the July 8th episode adds to the series map. The prior episode was about the market repricing the physical costs behind AI. This one is about the response. If the world is more fragile, companies will pay up for control. That means paying up for domestic manufacturing, paying up for strategic suppliers, paying up for redundancy, paying up for CapEx that may look inefficient in a calm world, but very rational in a rough one. CapEx just means spending money to build long-lived assets, factories, equipment, chip capacity, data centers, physical infrastructure. And the important part is that this kind of spending is not always about being cheap. Sometimes it is about being less fragile. If a part is mission critical, the question is not only where can I get it at the lowest price? The better question becomes, can I get it when I need it? Can I get it if shipping lanes are tense? Can I get it if tariffs move again? Can I get it if politicians start asking where the technology stack is made? That is a very different kind of business math. In a low-rate, ultra-globalized world, the obsession was often optimization. Where is it cheapest? Where is it fastest? How lean can we run this? In a world with war risk, tariff risk, energy risk, and persistent inflation risk, the obsession starts to shift. Who can I trust? Where can I get supply without being trapped? How do I shorten the chain between design and delivery? That is why I think the Apple-Broadcom announcement belongs in the same episode as the Hormuz story and the Federal Reserve minutes. They are all about control of physical bottlenecks. And that has a market implication. If you are a huge company with cash, scale, and bargaining power, this world is annoying but manageable. You can sign giant supply deals, you can fund domestic production, you can absorb some volatility. If you are smaller, more levered, or more dependent on cheap global inputs, this world gets much harsher. That is one reason I keep saying the economy is not just moving up or down, it is splitting. The strongest players can buy resilience. The weaker players have to rent it, and renting resilience in a high-rate world is expensive. There is also a deeper A, I point here. A lot of people still talk about AI as if the story ends at model quality or software features. I think the next few chapters will care more about who can secure chips, power, cooling, land, financing, and political permission without blowing up their margins. That is a much less glamorous story. It is also a much more investable reality, though this channel is not giving investment advice. It is simply the map of where leverage is shifting. The consumer angle is quieter, but it matters because this is where the AI control story leaves Wall Street and touches normal people. If energy risk keeps rates higher, the winners may be companies with cash, but the losers may be households waiting for cheaper mortgages that never show up. The New York Federal Reserve's June survey of consumer expectations, released July 7th, said one-year inflation expectations rose to 3.7%, the highest level since September 2023. Three-year expectations rose to 3.3%. That does not mean inflation is exploding again. It means consumers are not fully convinced the problem is solved, and that matters when the market is already nervous about oil and long-term rates. This is where the split economy theme can re-enter if the pattern continues. Higher income households with stock exposure and fixed low mortgage rates may still look fine. A big corporation may keep funding CapEx, but a first-time home buyer, a smaller business owner, or a household staring at insurance, rent, and grocery bills does not experience the economy the same way. That is why I do not like bland lines about the consumer remains resilient. Which consumer resilient, how, against what? July 8th did not answer all of that. But it did remind us where the next squeeze shows up first: fuel, mortgages, and financing. Very cheerful summer material. Truly the soundtrack of a relaxing beach day. The mechanism is straightforward once you strip the jargon out. This is the central map of the episode. Control of routes, control of chips, and control of capital. Control of routes affects energy cost. If a choke point like Hormuz gets tense, oil does not have to explode forever to matter. It only has to hold enough of a risk premium to make companies and consumers nervous. That risk premium can move through the system like this: oil, then inflation risk, then pressure on margins, then less room for the Federal Reserve to ease. Control of chips affects production risk. The Apple-Broadcom deal is not about Nvidia-style AI accelerators. It is about radio frequency and connectivity components, but that is why it is useful for this thesis. The control story is bigger than GPUs. If critical pieces of the technology stack are harder to source, more political, or more exposed to shipping and tariff risk, then companies with secure supply have an advantage. Control of capital affects who can keep building when financing is expensive. The 10-year and 30-year Treasury yields are not just bond market trivia. They change the cost of mortgages, credit projects, and long-duration growth stories. If money is cheap, more companies can keep dreaming. If money is expensive, the market starts asking who can actually pay for the dream. Put those together and AI becomes less like a pure software race and more like an industrial race. The software still matters. Of course it matters, but the software sits on power, chips, land, cooling, logistics, political permission, and financing. That is why one episode can include Hormuz, Federal Reserve minutes, home builders, and an Apple supplier deal without becoming a random news pile. They are different doors into the same machine. The likely winners in this setup are companies and sectors with actual control. Energy producers, if supply risk stays in the background. Strategic industrial and chip suppliers tied to domestic build-out. Grid, cooling, and power infrastructure companies if AI demand keeps pulling on electricity. Big cash-generating firms that can self-fund CapEx instead of begging the bond market for mercy. The likely losers or squeezed groups are easier to spot too. Housing and housing-adjacent businesses if long rates stay high. Travel and leisure names with heavy fuel exposure, smaller or more indebted companies that still need easy refinancing, households waiting for mortgage relief that never quite arrives. And then there is the middle group, the companies that still have a good AI story, but now have to prove they can defend margins while the physical world gets more expensive and more political. That is where the sorting process gets interesting. The main risk to this thesis is that I am turning one volatile summer tape into something bigger than it really is. Oil could cool down quickly if the conflict settles again. The Federal Reserve minutes could end up looking tougher on paper than policy becomes in practice. The NASDAQ finishing green is a warning against overstating the damage to big tech confidence. And Apple's Broadcom deal may prove more company-specific than regime-changing. So I am not saying this guarantees a permanent shift. I'm saying this is where pressure is building. If the next few checkpoints show lower oil, lower long-end yields, calmer shipping risk, and better housing behavior, then I would downgrade this from a structural warning to a noisy but temporary scare. I am watching 5 trigger points. First, oil. If Brent fades back toward the low to mid-70s, this looks less structural. If Brent holds near or above the $78 to $80 zone, the risk premium is still alive. Second, long rates. If the 10-year keeps pressing toward 4.6% and the 30-year stays above 5%, housing pressure probably does not go away. Third, the weak spots. If housing and travel stocks keep acting worse than the headline indexes, the market is still punishing fuel and financing exposure. Fourth, corporate language. If more companies talk like Apple, meaning secure supply, domestic capacity, and strategic sourcing, then control is becoming a corporate priority, not just a one-day headline. And fifth, inflation data. If the next inflation readings confirm the worry that consumers and the bond market are starting to show, then the Federal Reserve has less room to give the market the easy relief it wants. If those keep lining up, then the bigger pattern gets harder to ignore.